लाइव चलते हैं.
Yep. So we are
Awesome.
live. Welcome everyone to this special stream where we are talking about Silicon Valley Bank. Uh, you
Hello.
would be you would be hearing all day that
Yes.
there's something that has went down with Silicon Valley Bank, and it's all across Twitter. And Deepak has also done a thread explaining it. So we'll directly jump to the issue. But before we do, let me set up a little context and tell you about this. So Silicon Valley Bank is not a small time bank. It is as big as HDFC Bank, which is India's largest private lender. And this bank predominantly lends to venture capital firms, the tech industry of Silicon Valley, the private equity firms, etc., etc. So it does not lend mainly to the retail, or it does not have deposits of the retail uh, clientele, but it has deposits of the private equity and the venture capital and the tech companies and all that. So this bank has troubles, which we'll discuss what and where. But one of the specific things to note here is that this is another classic case of a bank not able to manage its money and going down. And every time we get different ways in which banks tend to screw up things. So why it is important for us sitting in India? Firstly, to figure out if it will impact any of the Indian tech sector or not, and secondly, to see what went wrong there. So whenever something similar happens here, we could be able to smell it and stay away from such businesses. So that done, Deepak, I'd like to invite you, and we could start with this episode, and you could take us through on what happened, and then we'll take it further. Hi, Deepak, you're there?
Back. Hi.
Yeah,
I
you're
think I
here.
lost.
Okay.
Okay. Awesome. So yeah, we were. I guess. Sorry. What was the question? Because I missed everything there.
Yes. So I set the context up. I've explained about what SVP Bank is, and how its investors, how its clientele, which is its depositors, are mainly the tech firms and the businesses and the private equity firms, and it is not a retail oriented bank. Now things have happened here in the way it has managed its deposits, and things have not went well. So I'd like you to first set up context on what went wrong, and then we'll see other layers of the whole issue.
Cool. Let me just do this. Okay. They released a press release, so I want to just share my screen that allows us to kind of understand. So what we have to understand before questions come in, and they haven't yet started coming in, is we have a situation right now with respect to a bank that has $169 billion in deposits. This is a situation where the stock's price has fallen. Well, let me see if I can open that. If I do investing.com, we're actually going to see SIVB. So you've got Silicon Valley Bank down 60%, and then another 20% after hours. I don't know if you can see this properly, but yeah, here you go. So this is the price of the the company, the stock price of the company. And why has it fallen like that? Because it suddenly decided to reveal something that was wrong with the financial position that it has. It has about $169 billion in deposits. It also has roughly, out of this, apparently 80 odd $billion was invested in mortgage-based securities, agency mortgage-based securities, and US treasuries, which are considered relatively safe, except they were not of short time duration. That is like something of the order of 3 months or 6 months to maturity. They were as much as 10 years to maturity or plus in case of mortgage-based securities. Mortgages typically are 30-year mortgages. So when they were being compiled and put into an MBS pool, that is eventually sold, securities from this pool are then sold to institutions and banks and so on, who typically buy them. And then when you pay your mortgage payments every month, some part of the interest goes and pays out the MBS security holders, and some part of the principal also gets reduced from the principal that is due. So over time they amortize. Now, What happens when you do this is you typically have to hold the security for approximately 10 years before you realize the money in total. And the yield that you've got, which is 1.5%, which is what Silicon Valley bought it at apparently last year, is what you will get if you hold it all the way to maturity. But what if you don't? What if you have to sell them today? Now, today, if I go and buy a US Treasury for 1 year, I will get 5%. That means if I put $100, I'll get $5. If I buy a 10-year US Treasury, I'll get $4, 4%. So the yield curve is inverted, but leave that aside. What does this actually mean? Both these rates mean that if I take a mortgage-based security, which new mortgage-based securities in the market are currently trading at 7% yields, which means that if I took my mortgage security, which is 1.5%, that means for every $100 I invested, I'm going to get $1.5 per year of interest back. How much will that sell for in the market? So if you do the calculations, it should be roughly $72 roughly. If that means if I have something that I bought at 100, today it's worth 72. You can say that, listen, I won't sell it at 72. I'll hold it all the way till maturity, and it'll become 100. That's perfectly fine. If you are able to do that. Unfortunately, the money you took from depositors, which were largely startups, they are not going to give you the money for 10 years. They've given you the money to park, and they want to use it to spend, to pay salaries, to buy stuff, and all of that things. And earlier, before 2021 or maybe early 2022, you had a situation where, some startups will take out money, but another startup will raise a lot of money. So technically, that money is available to me for the long term. That's what you think. Except the Fed started increasing rates. New funding slowed considerably. Their own the companies that they owned, the cash flow reduced substantially in the sense of they weren't getting any income. They were just spending, and they were not reducing their spending. They were hoping, I think, this crisis will kind of go away very fast, and they were continuing to spend the same amount. So Silicon Valley Bank, as the banker, started seeing cash outflows. Now, if you have your money liquidity locked into these long-term assets, which are currently valued at 30, 25, 30% lower than what others are. And by the way, mortgage-based securities is a different market. You will find that in an MBS market, one of the biggest buyers till last year was the Fed. The Fed, since the QE started, there were multiple layers of QE. They have been buying mortgage-based securities all the way through. Now, you come to, and it's a very interesting question about ALM, and I'll come to that. But before we get there, we have to understand that in 2021, it probably wasn't very visible to the bank that, when rates go up, all of these things will happen. The Fed stopped buying MBS because it was the largest buyer in this market. Rates of MBS went from 1.5 to 7%. No, that's quite a lot of difference, because if your long-term rates are still 4% for the government bonds, mortgage-based rates are 7%, much higher. And that much higher is not because of higher risk. It's just because there are not enough buyers for MBS as it used to be earlier. Now you've got a situation where banks have to reduce reduce their exposure. Silicon Valley Bank itself has to reduce its exposure to MBS because it needs money. It needs to invest not in long-term securities like mortgage-based securities, but to have short-term treasuries available, because customers were starting to take out funds. This was till yesterday. Yesterday, when they announced this, things changed. What's changed now is everybody's panicking, and the end result of all of this is that people are thinking that Silicon Valley Bank will not be able to pay them back, and therefore take your money out before it's locked in. What does locked in mean? Bank could say, listen, you guys are all taking out your money at the same time. I don't want you to. I have stuff which is good, but I can't sell it for a meaningful value right now. So I might have to ask you guys to hold. Now, for a startup, having money in the bank which is not accessible to you is, I don't know, is it money if you can't touch it? It's probably not anymore, right? So you have that problem that you don't want to hit you. So you want to panic first. So everybody's panicking. Everybody's telling their investors are telling their startups to take their money out. Investors themselves who have money in Silicon Valley Bank will take their money, are probably taking their money out or trying to take their money out, and so on. Situations have happened. What has happened really is they said they'll take strategic actions to strengthen their financial position. They want to, okay, they're putting it in some nice marketing-ish way. They want to do, they want to lock in higher short term. Basically, you want to get out of the long term stuff and put it into short term stuff. And uh, what they've done is they've sold something called their available for securities uh, portfolio, all of it. Which means, so when you buy assets, you have two choices on your balance sheet. You can say, I want to hold it till maturity, or I want to sell it and I want it to be made available for sale whenever I want. The difference in accounting is when you hold to maturity, you don't have to worry that the price of the security has gone to $72 instead of $100. Because then you say, well, I'm holding to maturity, it's eventually going to go back to $100 in 10 years. So I'll just hold it till then. I don't have to take any losses today. The available for sale AFS securities are mark to market every quarter, so you'll see that loss hit their balance sheet. At least that's the way it works in India. I don't know, the US must have similar rules, but this means that the losses that they've incurred in their portfolio, they've already incurred. They've already probably hit. What they've done right now is they have sold all of that available for sale property. They want to reinvest the proceeds into short-term debt, and at the same time they want to raise $2.25 billion of this. And I think there's General Atlantic, which has said that they will commit to invest. I don't get this. You're, okay, I'll come back to that. I mean, why would somebody commit to it? Why don't they just invest and then go raise the rest of the money from somebody else? But that's again trouble, right? General Atlantic might have said, I'll only invest if you're able to raise money from outside, which is a sign that they are also aware of the problems in the bank. Okay, so wherever that is a different, wherever that goes is a different thing. But essentially what they're doing, what they've said is they have sold $21 billion worth of securities. They have, the yield was, they say it's a 3.6 year duration, but that's just duration. The time to maturity can still be 10 years. Forget the complications, but they're actually going to raise $1.25 billion plus $500 million because they have estimated a loss of $1.8 billion after tax. So if the tax was 25% or 30% or whatever it was, they actually lost 2 point something billion dollars, but they get a tax offset. So when they've lost this 2 billion plus, what are they going to do? They're going to increase their common equity ratio and all that stuff by only 0.15%. The one thing I don't know, and if anybody knows this, tell me, how much equity do they have? So I was trying to find it, and in India you do some things, in the US you have to do something else. So I haven't been able to find their total equity in terms of number of dollars. So anybody please find this and let me know, because this $2 billion hit loss takes away from their capital. So if they had a 15 billion capital to begin with in December, now they have 13 billion. They don't give the numbers in this presentation. They only give you as a percentage, but a percentage of what is the question. Okay, so we've got this. And then what they've said, well, they go down here. They say, well, we've sold $21 billion in this and that and stuff. So sorry, Nate, go ahead.
So, Deepak, I have a question. So the way you explained it, what happened was the startups would be depositing, or the private equity firms and everyone from the Silicon Valley, the tech guys would be putting their money with Silicon Valley Bank, and the bank went ahead and bought debt securities and MBS and everything with the whole basket yielding 1.5%. And after that, interest rates started going up, and now they are in a position where they have lost substantial money. My question is that the interest rate cycle turned and Fed started increasing rates every 2-3 weeks. And it was a gradual process. Things did not go from 1.5 to 5% overnight. So didn't so my question is, was the bank being stupid by not converting from long term duration securities to short term securities, or was it something sinister? So is it stupid or sinister is my question.
Okay, this is a good question. I don't know. Sometimes we attribute malice to what is incompetence. So I won't want to, I don't want to bash up the bank for that. Let me just try and figure out where their position is. So they were $181 billion in deposits in December 2021. Okay, this is before all the crisis started. December 2021 was where the situation was. So they're saying, well, UBC activity has reduced. If you look at the numbers here, they're saying they're $169 billion of deposits. So from 181 to come to 169 is a matter of only $12 billion. So they've seen $12 billion flow out net in 1 year and 2 months. That is not a big deal, uh, primarily. This is another thing called 165 billion off balance sheet assets. We will come to that. That is okay. That is another crazy thing, but it's specific to probably Silicon Valley Bank, and it's not so bad. But this is a fairly large off balance sheet item to be on their balance to be on the presentation. Again, they have off balance sheet. So the deposits that they're talking about. I mean, there's 169 and 165. Just a small difference here in two different ways that you look at it. But here's the interesting part. With $12 billion gone, they decided that, listen, we've got to liquidate our entire $21 billion mark to market available for sale portfolio, which means they've already taken much of the losses on this already, but they've probably taken a little more in the last 2 months. They've decided to sell it all. What does this give them? It gives them $21 billion that they can easily give away to anybody who wants their money back, or they can park in really short-term securities like 3-month T-bills or 1-month T-bills and so on. This is good for them. However, they should have been doing this in the last year, like you said. They should have been saying, oh, rates are going up. We're going to have problems with our MBS portfolio. We have 80 or $90 billion. They probably have, they've given loans. The loan book is only about 40 odd percent of this. So in the sense of, if they have, $169 billion in deposits, they probably have given loan worth 100 billion. I mean, maybe less than 100 billion also. The remaining money sits as either treasuries or cash. So essentially, they lend out to other companies. Actual loans that they give are only 40-45% of their overall deposit book. The remaining is invested in government securities and all of that. That is about, say, 80 or 90 billion. And of this 80 billion, 21 billion has been sold, and the remaining is probably in hold to maturity securities. That means on that remaining 59 billion or so, they've not yet taken any losses. So even if the prices have fallen 30%, they've not taken them, they're hold to maturity. So one of the reasons they probably didn't want to take the losses on any of the hold to maturity securities was, once you do that, then it hits your income statement, it hits your balance sheet, your equity falls down, your tier 1 ratios look bad, and so on. So they probably were afraid of that. But if you're a conservative bank, you need to be doing this regularly. And remember, they bought good stuff. It's not like they bought bad stuff. They bought government bonds and government agency backed securities. So there's no credit risk, in the sense nobody's defaulting on them right now. But the fact is that you've also got you got something else called market risk. Now, market risk contains two things. Market risk contains an asset liability mismatch area where you're saying that I have, sorry, not, let's put the ALM parts separately, but this market risk has something that says, well, I cannot sell my security because it's illiquid. It's a bond. Nobody wants this bond. I can't find a buyer. So I have the bond, but I can't sell it and realize any money right now. That's liquidity risk. There is no liquidity risk here. You can sell these bonds anytime. There's always going to be a buyer there somewhere. But the price at which the buyer exists, it's very, very low compared to what you thought you'll be able to sell it at. So this liquidity risk has come in as part of market risk for two reasons again. One of the reasons is that a Fed has raised interest rates. The second reason, and importantly, the Fed has stopped buying MBS. The Fed used to buy MBS all the time. So now they've stopped. One of the biggest buyers of MBS has stopped buying MBS, means less buyers, less demand, equivalent amount of supply. So you obviously have prices fall and yields go up. So what was 1.5% has become 7%. So effectively with this, you have this market risk hitting institution, which did not try to take risk on the actual credit. So if you look at their numbers, they actually talk about this. Okay, I'll go down here and I say, oh, that's what they're saying. They're saying we've not lent to some bad things. we've only lent to good things. So where is that? Where is this? Is a big sheet over here somewhere. I hope I can find it. Um,
And
Here we go. Here.
probably the
This
third
is the
point
one.
why this happened was because the deposits dried up. If you look at 2019 to 2021, this was the time when tech stocks were doing IPOs. There was a lot of private equity activity. So there was a lot of money
Liquidity.
coming in into the tech companies and tech stocks, and that money was being deposited here. So in a way, they were able to get more money in. As against what they were paying out. Now that money coming in has dried up. All the venture capital firms have said that all the companies need to cut costs and they need to preserve their cash. So now they are dipping into their savings for all their expenses, and
Yeah, I
that's
mean
why
that is
this outflow of money is also happening. So in a way, with rising interest rates, the
yes.
party has
So
come to
it's
an end, and
interesting.
so they are yeah,
Yeah,
yeah.
that it is that. In fact, here you come to, if you look at the high, they call it a high quality liquid balance sheet. The problem is not high quality or liquid. It is at what price are you getting this liquidity? It's if it just because it's liquid does not mean you're getting the price you think you want. That a liquid doesn't mean that you won't make losses. So the problem right now has come to, if I liquidate my portfolio, I'm going to take such a big loss. It's going to wipe out a significant amount of my asset base. So you got 62% of their assets in cash and high quality fixed income securities, and still this bank is at the risk of going under. Why? This is the interesting thing about all of this. You got, you know everybody else has 75% lending and 25% high quality liquid assets. These guys relatively have a low amount of loans, only 43%, like I said. But what are these loans in? So one part of it, and let me look at this portfolio that they call X1Y. Okay, so you've got something called primarily PEVC call lines secured by LP capital commitments. What does this mean? It's like this. You've got a situation where a PE fund says, I have gone and raised money from, I don't know, 12 different wealthy individuals. But they've not given me the money yet because I haven't deployed it. I haven't found any startups to buy it. So Silicon Valley Bank says, listen, you know what, when you're ready to want to buy or take some money, I'll give you a line of credit. And, because what you'll do is you'll put a cash call on your LP, limited partner. The LP will then maybe take 2 or 3 days to give you the money. They'll give it to you. They'll give it to Silicon Valley Bank in your account in Silicon Valley Bank. So, but if you need the money immediately, you can take the money. We'll back it with the capital call. So they've got a capital call backed line of which is 56%. This is what I think is off balance sheet, because this is just that they'll have to lend it out, and there is an off balance sheet liability, which is they have to. It's like a deposit where they haven't yet got the money, but they're sure they're going to get the money. That kind of thing. So the problem right now is, first, you have a situation in which, because the market funding is so bad, it's likely that if you make a capital call, the guy on the other side might say, listen, I'm not going to pay. I know it's tough. I know I committed to it last time, but maybe this is not the right time for me to put the money in. And at the same time, the PEVC fund may use the line of credit to take the money up front. So you have a potential situation over there, which may not last too long, because these contracts are legally enforceable. But situations change very fast. So even in this, there has been a net loss since inception. But technically, they think that this is safe. What might be happening right now is VCs that have taken capital calls and are not, now nobody's going to pay Silicon Valley Bank anything. So the whole thing will be in a toss. The other one is they've got some LTV mortgages. They've lent money to some wine providers, to some growth stage companies, early stage companies, CREs. So a bunch of things over here. This isn't worrying so much. What's worrying is all the startups that put money with them. They're the ones that are taking money out, and they could take out, let's say, I don't know, $50 billion. They can't go to these wine guys and say, give me my money back immediately. The wine guy will be like, dude, I don't have the money. And then, what do? You can't sell their winery in like a day. So you're going to have a problem where the startup has taken out its money today, but you can sell the winery only 1 month later. So that part of your money is blocked. You need the money from somewhere to kind of bridge this 1 month gap. This is the asset liability mismatch. Your liabilities are immediate, but your assets are longer term, and therefore you can't get out. A winery is an example of an illiquid asset. You can't sell it easily and fast. A mortgage based security is a liquid asset. You can sell it, but the minute you do, if it's a hold to maturity asset, and they've got only hold to maturity assets, it's all gone, it's all going to go down. Now, what's the impact of it? Startups that have money in this will probably have to depend on their VCs and perhaps their own assessment of whether they need to take the money out now. Apparently, a lot of them have already started to take their money out. Worse, some, in fact, I saw a Razor Pay and a bunch of other companies have set up a new business division to help Indian startups take their money out of Silicon Valley Bank and bring it back to India. Imagine a Silicon Valley bank is safer than India. Sorry, is less safe than Indian banks. And what is SVB's credit rating? I don't know what it is, but apparently it fell today to BBB minus. This is India's sovereign credit rating. Okay, I think BBB or BBB minus is India's sovereign credit rating. So, but of course, India is way safer. Don't have any such problems whatsoever, even when it's in dollars. But more importantly, because these startups are now moving their money back, and a lot of Indian startups use SVB, the VCs that serve Indian startups also make them open accounts in SVB so they can transfer easily. I have, for a friend, helped him invest in an angel kind of a fund in the US through the ODI route in India, and that goes into a Silicon Valley Bank account. So all of this stuff, all of this, this concept has had SVB involved. So a big hit could be taken by the startup ecosystem if there is a moratorium of any sort, if there's no rescue. But think of it from a perspective of who'll rescue it. But I'll stop here. Any questions, any thoughts?
I did a quick Google search, and Wikipedia says that the total equity of this is $16.24 billion as of 2021.
2021.
Huh.
Okay, they've taken some losses after that for sure. We could do a search. I don't know if so Silicon Valley Bank, they have a investor research, some center or something like that. So this is an ALM issue, yes, but the ALM issue is caused by market risk. They have liquid securities that are liquid at a much lower value. They should have been seeing this hit their portfolio and therefore reduced their hold to maturity portfolio, or change that hold to maturity portfolio into shorter term treasuries, which allows them to pay off their depositors quickly. Now remember, they don't have traditional depositors. They're not like people like you and me who are depositing money in Silicon Valley Bank. They're startups. Startups by nature need money very quickly. So if you're running a business in which your primary depositors are people who are taking out money by the millions all the time, and you are aware that the funding, a new funding that's coming in, is reducing all the time, you must be expecting a net outflow. If you're expecting a net outflow, why aren't you doing something that is dramatically going into a much more liquid portfolio? But then you got what, 12, 13 years of the Federal Reserve saying, don't worry, we've got your back. And the one time that they said, we don't have your back, nobody believed them anymore. Because 3 times they said, we will reduce rates, or increase rates, we'll increase rates. And whenever they try to increase rates, some dramatic thing would happen, they would go and reduce rates again. They did this in 2013 with a taper, or a talk of a taper. They did an actual taper in 2019, and they got they started reducing rates in 2019, way before COVID. That was because of a crisis that happened again in the bond market. So you have a situation where the Fed says we'll do something, and then as soon as something bad happens, they come and rescue everybody. Even now, I think the point over here is the Federal Reserve is going to have to work the weekend, to figure out a rescue plan, because you can't let a bank like this go under, and it doesn't even sound fair. The guy invested in like mortgage-based securities for which sounds like a perfect thing to rescue. Was SVB? I have no idea, but there's probably a backstory to this. To having this. So let me just see whether you can get something over here. Blah blah blah, and we've got a mid-quarter update. And is this what it is? Yeah, this is what it is. But what I want to know is, well, I just want to know their financials actually, quarterly results, and then if there is well, earnings slides, earnings release. So you might actually have a 2022 Q4. Yeah, you can check if this is there. If Fed interest rates, yeah, I mean, so they will be. It could continue to hurt them if they don't take the losses and raise. What's the way to get out of this crisis? They have $16 billion in equity. That's what we said, right? So let me just see here how much equity they have. Income statement. I need the balance sheet. Okay, there is a bunch of things here. Loans, is the credit quality, client funds. Yeah, I mean, you can see over here what do they have as both assets and liabilities. This is their liabilities, and this is their credit quality and their loans. So I think they might be. I haven't seen this. I'm sorry. I was trying to find this earlier and I couldn't find it. I found it right now, but it's not the right time to start looking at these things. However, yeah. So you can see over here that there's been a slight decline in their common equity tier one, because maybe some losses have been taken. Their tier one ratio also from 2021 of 16%, they've come down to 15 odd percent. And some part of that will be. Yeah, the decreases were due to the growth in our risk-weighted assets, which means when you buy something that is essentially considered low risk, the regulatory capital you need to against buying a government security or an agency MBS is probably far lesser than if I gave out a loan, instead. So my risk-weighted assets increase if I give more loans. My risk-weighted assets decrease if I use money to buy government securities instead. So this was just an increase that came in, but I still don't know where their equity is. There's a book value per share, which is the total. I don't know the total number of shares that they have. Okay, so we haven't got it. We haven't got. I mean, I don't have the numbers right now, but yeah, the idea now is whatever equity you have, assume that 50% of it is going to get hit. Let's say you have $60 billion and you have a 20% loss to take. That's $12 billion of a loss that you could take in case you have to return all the money to your customers, right? So let's say that $12 billion, something you take entirely right now. How much is how much you're left with? You're left with only $4 billion because you had $16 billion of equity. What you should go there and try and raise, I don't know, use a Warren Buffett, whatever it is, get $5 or $10 billion more. So you get another 10 or 15, 10 to $12 billion. You can repay most of the people who are trying to get out. You have the ability to now survive. You will, of course, dilute the hell out of all of your investors, which means anybody who owns equity in Silicon Valley Bank gets diluted by 75 or 80%. It doesn't matter. You're in trouble. You have to do this. If you don't do this by yourself, the Fed and the other banks will, and there will be a bankruptcy situation, and you will be forced to do this with, forget diluting 75%, you'll have to dilute 100%, which means you lose all your equity and a new set of people will come in. This is not a bank that does not have assets. It has assets, which are good assets. It's just that there are losses, so they'll take equity losses. Depositors are unlikely to lose money, at least in my view. From now, what I see, there's not going to be a huge doing. Yeah, here you go. Okay, sorry, Parag Pai talks about 150 puts. You can't buy a put on your own share. That would be just crazy. Or your own bonds. You just can't do it. I mean, how can you buy a put against your own bonds? That means somebody will have to pay you if you go bankrupt, and you could engineer your own bankruptcy by doing stupid things. So that does not sound like the right thing to do. I don't think any regulator will allow you to do such things. But given this,
Uh,
I think, sorry, go on.
yeah, there is a question here, Deepak. Would again an increase in interest rates by Fed would have more problems for this bank, or they have
If they,
just taken the
if
hit
they continue like
full on?
this, yes. So, for instance, if they sell all the MBS today, take the losses, convert them to short term treasuries, then there won't be any further major losses, right? So, something that is 10 years in duration, when interest rates rise, the prices fall so much. When interest rates rise for a short term security, prices fall so much. So it's the distance, the scale of the fall reduces if your duration is much smaller. So they will just, a new buyer may come in and say, forget all this MBS, sell it, come back. Why haven't mainstream banks come? Of course, because they don't have the same problem, in the sense they'll have short-term treasuries and long-term stuff. Plus, in Silicon Valley's bank's case, it's a very strange situation. I mean, honestly, if any other bank was faced with, say, 50% of its or 30% of its deposits going out, they would also have problems, because most banks lend out 75% of what they get as deposits, right? They only have 25% available in high liquid security. So if 30% of those customers, 30% of their customers, depositors said, we want our money back, it's the end of the story. Silicon Valley Bank is in a peculiar situation where its customers tend to be people who need a lot of money all the time. And once even 5% of those people, and they've lost only 5% of deposits, if only 5% of deposits went out, they ended up with a little bit of a liquidity problem. For other banks, it would have been much worse. Silicon Valley Bank was okay. And then they went ahead and did this offering and created panic in the marketplace. They didn't create it. There was panic. They tried to solve that panic by saying, don't panic, which is the worst thing to say to people who are panicking, because they will panic even more. So the big problem now is you need a rescuer. There is no choice. This is just basically leveraged companies. Banks are leveraged by the nature of it. Their leverage ratio is really 12x to 1. So that means for every dollar they have in their own equity, they have lent out $12. They have a balance sheet which is $12 higher, so or 12 times more. So they are essentially leveraged. So at 12% leverage, if you lose 8% of in whatever you've invested in, that 8% wipes out your entire capital. Given that they've invested half of their the assets that they've got in something that has lost probably 10 or 15%, they're probably ending up with very little equity in the company right now. So shareholders look like it's going to be a very bad weekend for them. I think
Also,
depositors should be okay.
Also, this bank is peculiar in a way that this bank has deposits from the institutions, whereas mainstream banks would have savings accounts from employees and vendors and everybody else. So whenever, and they also have a lot of current account, saving account, whatever it is called there, maybe check-in account. They have a lot of check-in accounts as well. So even if institutions take out money, they would be ending up paying salaries and paying to their vendors and spending somewhere else, which will again come back to the bank in some way in a bank account. So maybe an HDFC bank and ICICI bank here would capture the whole ecosystem where a current account is also there in the same bank and you are making the salary also in the same bank. So the money never leaves the bank in a way. So so the structure of the bank and probably the business of the model of the bank had them, because there are fewer institutions, and they are all connected. So when 5% of the people take out money, the other people are also inclined to take out the money. So bank
See,
runs
I
are
mean,
easier.
yeah, this is exactly what happened in India as well, right? Earlier, we had infrastructure financing. Infrastructure is a 20-year project. You can't take out money of an infrastructure project immediately, and banks were financing them. And banks had depositors. So if any bank that was financing an infrastructure project required liquidity, they would be always in trouble. Of course, RBI came to their rescue, but there were infrastructure financial institutions like IDFC. IDFC's primary job was to finance infrastructure, but they would get only 5-year bonds. So they would do and after every 5 years they had to refinance those bonds. When they came for refinancing, if they got a very high rate, their entire IRR would come down. So this was a situation. They converted to a bank so they could get more retail money in. So they've diversified away from that. Still, having a 20-25% of your depositors withdraw money is pretty much. Oh, it's definitely not a black swan situation. Definitely not a black. Forget them. Everybody saw this, right? At Silvergate, another bank which has only $12 billion, which did not lend to crypto companies. It borrowed from, it got deposits from crypto companies, and those crypto companies either went bust or are in the process of losing a lot of money, and therefore they are taking the money out of Silvergate. Silvergate itself invested in long-term securities, and they are seeing the impact of it. I think somebody at Silicon Valley Bank was like, "Hey, this can happen to us," and then decide to take this action now, post facto, everything. So, uh, unfortunately, they
There was
decided to
this
even raise capital.
there was this observation by Matt Levin in his newsletter a few days back on Silvergate. Silvergate had 12 billion of deposits from crypto firms, where it was that Silvergate would take money from these companies just to keep their money. So on 12 billion, it was making some 250 billion in terms of the commissions it used to take from these crypto firms, and all of its expenses was 114 billion. So no, it was not taking anything from crypto firms. It was just keeping their money as a current account. Expenses was 120 million something, and if it have put that money in government treasuries of 3 months, it would have made 240 million. तो कुछ नहीं करना था. You had to just buy government bonds, keep it, and pay all your expenses, and still make $120 million, and still they managed to to be in
Yeah,
this
you got years and years of zero interest rates. No, they've basically
right.
banged it into your head. Key rates are going to remain low for a long time, and then they say, "Oh, I'm sorry, we lied." So
And
you
this is
know,
frog in a pot syndrome. They can't imagine a situation where interest rate would go up or inflation would go up, and now it has. So
yeah, and in fact, I think we've got Roshan talk about this, which is it possible that the same issue is there with other banks too? Of course, it is a problem. And if you look at the situation where I mean, so the interesting piece is this, okay? And I'm sorry, I should probably stop sharing because this is no longer useful. Um, if you've got a situation um, where am I? I was talking about this. Yeah, sorry. Yeah. If you got a situation where the Fed is raising rates and a lot of banks have high HTM assets, hold to maturity assets, they're facing those losses on that portfolio. Now, let me ask you this. Okay, I give you 100 rupees and I say, listen, I'm mostly not going to take it back, but I can take it back whenever I want. What will you do with that money? First year, you'll say, I'll put in short term government bond. I get 0.25%. Deepak is not taking back his money. Maybe we should maybe we'll put 10 rupees in long term government bonds and 90 rupees I'll keep. Then next year also I don't make any money. Now you're looking at your thing and saying, on the long term I made 2%, on the short term I'm still making 0.5. So ऐसा करते हैं ना, we'll find out कि Deepak will withdraw how much. You do complicated Excel sheet and you say maximum Deepak will withdraw is 50. And then Excel sheet say, we said, okay, we can take 50 and put it in long term, 50 will put in short term. Very good. This is assuming you're not making any loans at all. I'm just saying you have made no loans. You can only invest in long term US government, I mean, Indian government bonds or short term Indian government bonds. And Indian rates are like close to zero. Next, what you have in the system is this 50%, which is long term, is yielding you higher, and the 50% of short term is yielding you very little. Interest rates go up. The 50% that is long term, you decide to hold to maturity, I will not take any loss. The 50 rupees that you had invested in long term has now, if you're market to market, it has fallen to, I don't know, 40 rupees, 20% fall. US treasuries fell 20% last year. So same way your short term securities may have lost only 2 or 3%. Okay. So what was 100 has become 40 plus 47, so 87. It's only a 13% loss overall. ठीक है, चलेगा, because you're not showing me, you're showing 97 because you're showing me 50 ka 50 and for 50 the remaining 50 has become 47. Now we're thinking 3% loss होता रहता है, ठीक है, no problem. Now suddenly Deepak comes in and says, I want 25 rupees. Now you say, yaar, 25 rupees kahan se launga? Okay, I have 47. I'll give 25 out of that. Now suddenly I have 22 short term and still 50 technically long term. Now you're thinking, boss, if Deepak comes and asks for another 25, where will I give it from? I have to reduce my hold to maturity. So if I take my hold to maturity and I say that 50 face value, I'll bring it down to 40 face value. But I've already lost 20%. When I move that down, I will have to show another loss. That means the 50 that was held to maturity has now become 40 held to maturity. So the remaining 10 which is there, I should be showing a loss on if I have made a loss on those securities, and I'll have to show that loss. Suddenly people can see that the bank has lost more money than it initially said it would. Deepak looks at this and says, boss, you are losing money. I want my money out. Give me 50 rupees back. So now I've already taken out 25. I take another 50 out. You're like, I'm finished. This is when you are a perfectly stable bank. In the sense, you have lent only to government securities. You have not given loans out at all. Suddenly you find that you have no equity left. All the money that you have saved and you try to sell into a market like this, it's probably already all your losses, and then you don't have enough money to pay Deepak back. This can happen even in a bank that has absolutely zero credit risk. That means it has not lent money to anybody but the government, and the losses come and hit you. Do we have regulations? Of course, we do, in the sense the banks are required to keep 21% high quality liquid assets, but our regulations are not enough to take care of this entire situation end to end. If somebody comes and withdraws 30% of deposits in any bank in India, even a payments bank, there could be trouble if the bank has not invested in only short-term securities for liquidity. India needs to change the regulation of high-quality liquid assets to high-quality liquid assets that are marked to market, which means don't tell me you have 100 crores of high-quality liquid assets. Tell me what they're worth in the market today. If they're worth 70, that means you have 70 crores of high-quality liquid assets. We don't need to have that rule.
Is this player big enough?
Well, of course, it's bigger than HDFC Bank, I think. Silicon Valley Bank is $170 billion. $170 billion today is what? 14 lakh crores in deposits. 14 lakh crores is like HDFC Bank itself has 13 lakh crores, I think. SBI is bigger, but HDFC Bank is India's second largest bank, and that's what is the size of HDFC Bank. So it is massive for India, but not very big for the US. US has much bigger banks. Even Europe has much bigger banks. China has much bigger banks. So in the world context, it may not be very big. The ones that it affects is ripple effect on the technology sector. Is there? Well, what happens in technology is that okay, let me give you this. Let's say whatever happens to SVB, if the depositors are safe, nobody gives a shit. Because none of these startups have invested in Silicon Valley Bank, right? They've given them money as a deposit. Then it's fine. If Silicon Valley Bank gets out there and says, boss, you can't withdraw your deposits for another 3 months because we're trying to find a way around the solution. They did this with Yes Bank. They gave only 15 days. But let's say in the US, because it's more complicated, they said 3 months. What happens now to the startup? वो salary कैसे देगा? Every month he's transferring from his Silicon Valley Bank account into India, as saying now he can't pay salaries. The minute you can't pay salaries, you're finished. You have to shut down, or you wait till that time that it ends, right? Employees are going to stay with you for those 3 months because employees have to pay rent, they have to pay for food, and you may have paid them a lot of these things, but not everybody has an emergency fund like we've talked about. So there is going to be a ripple effect if there is a moratorium, if this situation is not resolved soon enough. Cool. I think.
Do you see any similar banks in India who have a similar structure where they mainly cater to institutions and not to any retail?
Well, there are. I mean, they don't have. So guys who have catered to institutions in some way, these institutions may not necessarily have immediate requirements. take money out. uh, and because of that, you might actually have a much better outcome uh, of a situation like this in a place like India, because in startups you're a high burn startup. You need cash all the time. In India, you may not necessarily have something like that.
Right. And maybe my last question here: is it ever possible to catch such issues with how companies handle their debt? Because we saw this with Franklin, where they were having securities in their credit risk mutual fund, which were having 10 years of expiry. It was a short term fund. And we saw this with Yes Bank. They had a lot of NPS which they were not able to cater to, and now we are seeing with this. So is there a way to capture this, or the reporting is so opaque that you will only know when the closet opens, that how many skeletons are there?
So yeah, an ALM report can tell you this. An liability mismatch report can tell you this in some meaningful way, that you have an asset liability mismatch. But what is your liability here? Okay, let me give you an example. HDFC Bank says it has 40% CASA. That means 40% of its money is in current account, savings account.
Right.
Technically, to me, that means 20% of their depositors can take out their money tomorrow, and almost
Hmm.
all of their fixed deposits are withdrawable on demand, correct? So
Right.
technically, all of HDFC's depositors can take out their money tomorrow. They can say, boss, paisa nikalo, mera FD close karo, fine, pay, take interest, take penalty, give it, I'll take it out and go. Does that mean HDFC Bank should not give loans? सिर्फ शॉर्ट टर्म गवर्नमेंट सिक्योरिटीज में डालेगा पैसा? At some point, everybody has an asset liability mismatch. Everybody in the world, every single bank in the world has an asset liability mismatch. Do you know that your housing loan can be called on demand? Most of your housing loan document आपने लिया होगा housing loan, उसमें है एक clause है. If the bank wants, it can call the full loan back whenever it decides. Nobody exercises this clause. वो clause है. Means you also have an asset liability mismatch. But क्या करोगे? You can say कि boss ले लो घर. At some point, if you want, if you're so desperate in another thing, or I'll go and refinance the loan from someone else. But you have to give me some time. So everybody has a asset liability mismatch at some extreme point. The problem in our lives is if we choose that extreme point to be closer and closer, so we keep saying कि नहीं उतना तो नहीं होगा. चल ठीक है 90% तो पैसा नहीं निकालेगा. 10% ही निकालेगा ना, तो 10% का शॉर्ट टर्म में रखते हैं अभी. सो इंडिया में वी हैव कम डाउन टू सम 18% और 20% or something, 21%. So 79% of our people should not take out their money suddenly. But 21%, if they take out, we have high quality liquid assets. We'll use that money to pay. That is what we are saying. Then we have RBI, which is the lender of last resort. It will say, तुम्हारे पास high liquid quality liquid asset है, उसको बेचो मत, मेरे को दो. I will give you loan. You use that loan to pay, and then later pay me back the loan. Whatever amount it is. This is fine. This is a good way to set up that boundary, but that boundary is arbitrary. It's in the sand. Tomorrow, if 22% of people withdraw, then क्या होगा? What does it change everything? And then today they will downgrade your credit. SVB's credit gets downgraded. So let us say there's a bond that SVB has issued, which says that if you are ever downgraded below this number, below this notch, we will call back our loan. So suddenly SVB is like, yeah, I took this bond from you for 6 years. In 3 years, you decided that some crisis has happened. I took it for 6 years because I wanted to do asset liability match, right? Because I have 6 years ka asset, I'll take 6 years ka liability. But the bond has one covenant that says that if your rating goes below this, I can call it anytime. So in 3 years, if your rating has gone down, you're thinking I am asset liability match. This fellow comes and says, "मेरे को अभी पैसा दे." This is not possible. This is not something that we should. I mean, this is basically, these kind of covenants are the ones that suck. But everybody wants them in the contract, thinking I won't exercise, but I want it because it gives me some nice good feeling. This nice good feeling is not, basically it will come into become nice bad feeling at the worst of times. So in essence, now what you've got is a full-blooded crisis. The only way to do this is get liquidity and get I mean, substantially dilute as many of the current shareholders as possible, get new equity, even massive 10, 15, $16 billion is fine. Get a huge amount of money in and stabilize the bank. Otherwise, you're just going to see a traditional bank run, and it's not nice because they've lent 40% of their assets to other people. Some of them are startups, some of them are wineries, some of them are good, probably small shops in Silicon Valley which have borrowed from Silicon Valley Bank. They suddenly be told, "Ki we are calling your loan right now." Not the best of things. So I mean, I think the crisis will develop. By this weekend, it should be a dead topic. But I can tell you this: you can lose a bank simply because even if it is lent in a pristine way to people who will pay it back, in case they don't recognize the extent of losses on their balance sheet and leverage themselves too much, exactly like LTCM did in 1998, when they had government bonds. They would short one government bond, go long the other government bond. The distance between the two widened. LTCM was too heavily leveraged. They lost all their money. 90% of the company was diluted. Banks took 90% of the assets for 3.6 billion. In 1.5 years, the $3.6 billion was fully paid back. After that, whatever more was realized was of big profit to the banking system. So nobody talks about this, but the rescue of this institution was a very profitable one for a lot of banks. And I think, given where you are, uh, the
So
rescue
was so
of
was Lehman Brothers.
huh?
So was rescue of Lehman Brothers
No,
profitable for a
Lehman
lot
Brothers
of people.
was a bust. As in, there was nobody made any profits. Very little profits were made. Some maybe. Bear Stearns also similar. Bad credit. They lent badly. It was not they lent well. So it's like DHFL's rescue. Was it profitable? The answer is I don't know. Maybe, maybe not, because the guys estimated he'll make so much. What if people go and say, "You are not DHFL, you are Piramal, I'm not giving you money." uh, and there are probably people saying that. So
Right.
at some level, the bad credit based lending, I don't feel too sorry about. But here it seems like, not that I'm sorry, I have nothing to be sorry about here, but uh, I'm I'm more like, I think might have been an oversight rather than something malicious. Though I know a lot of people will disagree, especially if you're affected directly, you'll be like, "Kya pagal ho gaye kya?" Like, that's the, I mean, or have you gone crazy? So, but, at this point, I think a
Yeah.
rescue is imminent. So we shouldn't, I mean, I hope at least. I mean, in the Indian context, if this had happened in India, I wouldn't worry so much. But in the US, I don't know how their situation changes, because they've let banks fail. So I don't know what that means.
Right. So I think we are closing down the call right now, and I just had an idea, Deepak. We should do a podcast on. There's a lot being said about how LTCM made its money, but there's very little on how they went bust, and maybe we should do a podcast on that, explaining what went wrong with LTCM. On that note, folks, thanks very much for joining in. We are on Twitter at the rate capitalmind underscore in and at the rate Deepak Shinoy. Please tweet to us if you like this session and let us know what else we could cover. Till next time, whenever something interesting happens in the market, we'll be back online. Hopefully, something positive happens. We don't want to be here coming whenever shit hits the fan. So, till then, it's thank you and bye bye from my side, and I'll head over to Deepak to for the final note.
Cool. Thank you. And thanks for listening. It's a afternoon session. So, and our markets seem to have taken it on the chin as well. But if this is the crisis that is supposed to be the breaking point crisis, it may not be such a bad one. So I would generally say that this is not exposing a massive hole in the banking system. I think there'll be a bigger crisis than this later, and that is the one to be worried about when there's actual credit risk. Otherwise, this one hopefully should be sorted in the next 2 or 3 days. Remember, it's backed by a lot of people who have money. A lot of people who have money are its customers, and a lot of money who are people who have money are eventually the borrowers as well. So I expect people with money to kind of figure their things out faster than people who don't have any money. So things will move fast, I hope. And maybe this video will be useless after Monday. But let's hope and pray that it is so, because otherwise things just get worse from here.
Sure.
I don't want to have to do another video cast on this topic because that will be far more depressing than this one.
Sure. On that note, thanks everyone, and I'm closing the call. Thank you.